Hello and welcome to our webinar series from A3 Management Consulting. My name is Matt Brown. I'm Vice President in the Management Consulting Division responsible for the energy practice. And today we're going to be talking about key drivers of carbon prices. Very important point here in energy and the impact of carbon prices on energy as well, of course, on their own merit. If you skip on through the disclaimer, there I am. I don't look quite like that anymore, unfortunately, lack of a haircut, but perhaps Mostyn and Bradley, you could introduce yourselves.
Hi, so Bradley Steele. I've worked at A3 for 7 years. I lead the carbon team, but also involved in gas and carbon capture and storage in particular.
Yeah, and hi, Mostyn Brown. Joined A3 in 2012, and I currently manage the carbon team. We've got a number of experts who look at carbon, both on the EU ETS side and also other markets like offsets.
I'd like to say no relation. So if you skip on to the next slide, just to say that please feel free to ask questions throughout the webinar. With the question panel, we had a bunch of questions on registration as well, and we will be doing a bit of Q&A at the end if time allows, which I'm sure it will. And also to say that the slide pack and a recording of the webinar will be emailed to all the attendees, so just so you know, that will be coming over the email as well. With that, I will hand over to Mostyn to start, and over to you. Thank you.
Thanks, Matt. So today the presentation is predominantly going to be talking about the EU ETS, but I thought I'd start by just setting the scene. So of course, over the last year or so, we've seen a number of extreme weather events related to climate change, whether that be forest fires in Australia and California, flooding in the UK, or heat waves stretching right across the whole of Europe. And of course, if global temperatures are continuing to go up, then that risk is also going to, of extreme weather, is also going to rise. Now, from the EU's perspective, they have the EU ETS, which is their flagship decarbonisation policy. And the key of this scheme is that actually participants can trade allowances amongst themselves, and by doing that, those that find emission reduction activities very costly can effectively pay those who find it cheaper to do so, and thereby deriving a carbon price. Now, of course, that carbon price gets passed on to consumers. In our sector, we're interested in this impact on the wholesale electricity price. And so if we look on the right-hand side, we can see that currently carbon prices contribute to something like 25 to 45% of the wholesale electricity price, depending on the market. And then across the board, across all the markets that we're showing here, that is only going to set to increase as we go forward. So as carbon prices are such an important driver of wholesale prices, the key questions to ask here are, how is the carbon price going to evolve, and in particular, what's going to drive that evolution? So to give you a snapshot of an answer, this is our Q2 carbon price track that is going to be released imminently. And as you can see, compared to historic standards, we can see a very sharp rise over time throughout the 2030s, 2040s, 2050s. And if we look at the drivers on the right-hand side, we can break this down into three large components. So firstly, we've got the short-term impacts of COVID and so on. Then the really strong driver is the decarbonisation targets, which ultimately drive the price. And then in addition, we've got a load of interacting policies that can move the price up or down, depending on which one we consider. So that's a quick overview. And that structure is going to form the backbone of our presentation here. And we'll end with concluding remarks, but if I pass over to Bradley now to give an introduction to the ETS to kick things off.
Thank you, Mostyn. So I'm aware we've got a range of attendees on this call with different backgrounds. So I'm going to give a quick run through of the ETS, what it covers, how it works, and a bit about how we might model it. And then I'm going to move on to COVID-19 and the Market Stability Reserve, and hopefully explain why we've grouped those two together. So next slide. The ETS covers about a third of the current emissions in the EU. Cap and trade scheme primarily intended to drive decarbonisation in three sectors, so power and heat, as well as industry and aviation. Power and industry are generally seen as two of the easier sectors to decarbonise, particularly power, when compared to the economy as a whole. Aviation is in the kind of harder bucket. Most of the rest of European emissions are covered under the effort sharing regulation. There's a range of policies across the EU for those, and there's a few other emissions that kind of don't come under either. Now, the basic idea behind the ETS, next slide, is quite simple. It drives decarbonisation through a falling supply of allowances. So if you emit CO2, you have to provide a matching allowance to balance that. And if the supply of those allowances decreases over time, so must the emissions. The trajectory is defined at the moment to 2030. It was initially expected that emissions would roughly track the supply of allowances. But after the financial crisis in 2008, that hasn't been the case, and emissions under the ETS have been significantly below the legal allowance limit. As well as that, the allowances actually supplied to the market haven't matched kind of that initial line drawn as the legal number. Initially, there was a significant extra supply from international offsets, and since then, various policies have restricted the supply to try and bring things back more into balance. Going forward, the main remaining policy to do that is the Market Stability Reserve, which we'll cover later. That gap has led to a large surplus of allowances. It started to reduce in the last few years, but there's still nearly a year's worth of emissions kind of hanging around in the system, meaning it's relatively long as a market, and it's going to take a while for that surplus to start getting used up. Now, to go on to give an idea of how prices get formed within that market on a theoretical basis, people broadly want to keep on acting much like they are today, emitting as they would today. But if the supply of allowances is less than people want to emit, somebody or some actors need to make decisions to reduce their emissions until you get to emissions balancing supply. That means we can construct a theoretical curve of who would make decisions when, but those decisions are typically going to depend on the carbon price. So we can construct an abatement curve looking at how much people will abate at different carbon prices, and get a sense of if a price rises to somewhere, who would choose to change their emitting patterns. So as an example, if you looked at 2030, if you need to abate about 700 million tonnes compared to current emission profiles case, you could move along that curve and say a price of about 40 euros should drive enough abatement decisions to bring the market back into balance. Now, that's a theoretical idea, but there's a lot of complications in the ETS. Firstly, you've got banking and borrowing, so it doesn't have to balance on any given year. As you've seen, it's been long for most of its history so far. But also that abatement curve is going to change every year as new technologies become cheaper or more available. And also the supply of allowances hasn't matched the legal cap. And it now, going forward, is dynamic in that it responds to how the market behaves as well. Just to give some idea of what's behind that abatement, if you step forward, we've got a big block there which we've marked as happening at zero carbon price, so regardless of what the carbon price is. That's things like renewable auctions, where if you commit to funding a certain amount of renewables, that gets brought out to market mostly independently of what the carbon price is, so it doesn't need a carbon price to drive it. Going further up, you have decisions like investing in energy efficiency, sometimes should just happen, sometimes costs a bit. And then merchant renewables, changes within industry to cleaner processes, fuel switching, and at the top end of the curve, things like carbon capture and storage and the introduction of hydrogen. So that gives some theoretical idea of how prices should be formed. If we look at actual prices on the next slide, historically, since the financial crisis, the market's been quite long and prices have been relatively low, so single figures for a substantial portion of this chart. That started to change in the last couple of years with prices heading up to 20 euros and above, as those policy changes have restricted supply and made the market a bit tighter. But I'd like to draw your attention to the far right of this chart. COVID-19 saw a substantial drop in market price, which was very quickly more than half of that kind of rebounded. And today, actually, market prices have recovered back to pre-COVID-19 levels. But a very significant blip that if we step on, I'll talk about now. So COVID-19 is clearly a big financial economic shock to Europe and to the world. If we want to have some idea of how we'd expect the carbon market to respond to that, we have a previous one from 2008-2009 to compare to. And back after the global financial crisis, there was a big drop in carbon prices. They roughly halved over a few months, and they stayed low for a long time afterwards. So that financial crisis, that recession, had a big major impact on carbon prices in the market. If you look at COVID-19, as I said, after a couple of weeks, the response was about 3 euros maybe. And it's since picked up. So it seems like a very different market response to the last financial crisis. Now, we're interested in understanding these things, and one of the ways we can ask why that might be is to go and have a look at our modeling of what we think the market should be doing. So for that, we use Ether on the next slide. It's a fundamentals model of the emissions trading scheme. That means it takes all the information we know about the market, potential abatement options, and it includes all the market rules and adjustments that I've discussed. It doesn't take as an input market prices, so it doesn't necessarily give current prices back out, but it's good at asking how should the price respond to something. So for COVID-19, we can ask that question on the next slide by giving it two scenarios. What if the world had continued on as we expected at the beginning of this year? Industry, aviation, power sectors had kept on emitting CO2, compared to seeing a big drop in emissions, COVID-driven in 2020, and then recovering over the subsequent years. So this particular scenario has emissions recovering or activity recovering back to where it would have been in 2023. That might be a slightly rosy picture of the long-term impact of COVID-19, but it's a short-term impact only scenario. And if we throw those two scenarios into Ether, it suggests we should see about a €7 drop in carbon prices if, and it's a big if, there's no change to the supply of permits. And I say that's a big if because we have the market stability reserve, which means that the supply of permits does respond to what happens within the market. So if we go on to the next slide, just to talk a bit about the market stability reserve, the ideas behind it are fairly simple. If the number of allowances in circulation is greater than the higher horizontal line you see there, allowances get withdrawn from the market. That's via restricting auctions in the subsequent year. If allowances drop below the lower line, some of those withdrawn allowances can get put back into the market. So effectively, it's designed to stabilize the allowances in circulation between those two lines. In a market that's kind of relatively close to balance, we'd expect it therefore to bring the allowance supply down into that band and keep it there. That's not necessarily what we or others expect to happen over the next few years now. As you've seen, the market has been quite long in the absence of the MSR. So if we go on to the next slide, we can show a scenario where, in this case, the allowances in circulation stays quite high, and the MSR keeps withdrawing from the market for more than the next decade. Now, the withdrawal rate is a bit higher in earlier years, reduces later, but you can see that withdrawal coming through. And if we ask the question on this kind of background picture, if we were to impose a emission shock, so in 2020, so let's say a group of industries emitted 100 million tonnes less than they would have otherwise, for a nice round number. If you step forward, then in 2020, that's going to mean there's 100 million tonnes more permits in circulation than would otherwise have been the case. And if nobody responds to that, so everyone keeps making the same emissions, same decisions they would otherwise have made, then the Market Stability Reserve is going to adjust for that by withdrawing a percentage of the allowances that are in circulation. So it will withdraw more allowances in the subsequent year, take out an extra 24 million tonnes in 2021, but it will keep doing that in years afterwards as well. So if you step forward, you can see that by 2030, nearly all of that 100 million tonnes that our demand shock added into the system has been taken up by the MSR. And if no one else changes their behavior, the market's only 18 million tonnes longer by then than it would have been otherwise. And just to make it clear, if the emitters who didn't emit that 100 million tonnes held on to those permits and otherwise bought and sold as they would have, they would still have those 100 million tonnes in 2030. They don't lose them. But 82 million tonnes less would have been auctioned to the market. So the rest of the market has less permits that they can acquire from auction. So the Market Stability Reserve acts as kind of a buffer, particularly strong in the early years where we have the stronger withdrawal rate and more future years to withdraw. But it soaks up a lot of that impact from the lower demand in 2020 for permits. So stepping forward, if we let Ether run as normal and include the actions of the MSR, that roughly takes off about 2/3 of the price drop we'd expect. So we'd only expect a couple of euros from this kind of short-term COVID-19 impact. So modeling is only ever one part of the story. It's an approximation of reality, but I hope that gives at least some idea of one of the reasons why the response to COVID-19 may have been so different to the response 12 years ago to the global financial crisis. Stepping forward, just some takeaways from this section. The MSR mops up demand changes now. It has less effect on demand changes in future. So the long-term impact of COVID-19, as that becomes clearer, may actually have more impact on market prices than the short-term effects do. It's possible that COVID-19 could leave some actors sitting on larger permit stocks. If they don't release those to the market, if they don't sell them when the price looks good, could actually increase the scarcity of permits via those larger stocks. But also the changes, the MSR has already been changed once since it was introduced, the policy change on leading to 24% withdrawal rates. It is an intrinsic part of the market, and any future changes are going to have a big impact on how the market develops and how prices develop. We assume one change will be made. There's a technical rule about how the allowances in circulation are calculated that excludes aviation. That means that the upper limit today is actually about 160 million tonnes below where you kind of expect it should be. That gap is only going to get bigger over time. So we expect that to change. If it doesn't, in fact, it could well mean that the MSR kept withdrawing forever. Likewise, any change to withdrawal rates has a straight flow through to the market. Okay, I'm now going to pass back to Mostyn, who's going to talk through something about decarbonisation targets and the changes in European policy and how we see that flowing through to the ETS.
Great, thanks, Bradley. So yeah, I'm going to give this a bit more color by stepping through some of the fundamentals. So if we consider where the demand for abatement comes from, and when I refer to abatement, I mean emissions reduction, we can revisit this graph that Bradley showed earlier with historic emissions in grey and then our supply of allowances in green. And of course, the green supply of allowances is set to fall over time. So if we impose another line on this graph showing what would happen if, in the absence of a carbon price, what would emissions be like? And so this is our estimation. And as you can see, over time, the gulf between that business as usual in the absence of a carbon price line and the actual supply of allowances grows over time. And the difference between these two lines basically drives the demand for abatement. Now, this is in a scenario where we've got our Q1 targets outlined here. If we were to actually tighten those targets as we have in Q2, that actually increases the demand for abatement. So if we just flip between those two states, you can see that the demand for abatement increases if you tighten the cap. And of course, referring back to Bradley's marginal cost curve, you know, this, if you imagine the demand curve is then creeping up this cost curve and it's more expensive to abate, and that's what drives the carbon price. So to give some rationale as to why we're choosing now to tighten our targets, we're looking at the arrival of the European Green Deal, which has the headline feature of getting to net zero emissions across the whole economy by 2050. So if we line that up in comparison to the current objective of 80% reduction, 80 to 95% reduction by 2050, this proposed new line is both a much steeper trajectory and also ends up at a net zero end goal. Now, there's a slight caveat in that this line includes LULUCF. So LULUCF stands for land use change and forestry, and that's all the carbon that's stored in terrestrial ecosystems, so soils and vegetation, and that sink accounts for about 300 million tonnes per year, equivalent to about 5 percentage points in terms of target reduction. And it's pretty clear without that, achieving net zero would be extremely hard. Now, there's been a lot of talk about net zero, and I just wanted to just pause on this point to explain why it's so important. And of course, it's the point. So temperatures will only ever stabilize when we reach net zero emissions. So for every ton of carbon that goes into the atmosphere, a ton needs to be sequestered, be that through natural means that I just talked about through LULUCF, but increasingly also attention is being diverted into negative emission technology, and that's really going to be a big trend going forward in the coming decades. So based on that backdrop of the European Green Deal, we thought now is the time to actually tighten our targets and bring it closer to that raised ambition. So if we just plot out again the European Commission targets in grey and compare that to our Q1 targets. It was only the high scenario that was even in the current range. So we have a pretty conservative outlook on the ambition that could be achieved. But if we show what we're assuming in Q2, we've increased that ambition by something like 10 percentage points across the scenarios in 2050. So it now means that the high the central is reaching 85% reduction by 2050 and a 95% reduction by 2060. Then in the high, we're taking a more ambitious approach, and so we reach 95% reduction by 2050 and net zero economy-wide emissions by 2060. We still think it's exceedingly challenging to meet this target in 2050, so it's only in the high that we even reach net zero, and that's not until 2060. Indeed, our low scenario captures the possibility that actually very weak progress gets made on this, and that we actually only achieve 75% reduction by 2050. Now, if we step through and look at the EU ETS targets, so these are our Q1 numbers, and if we overlay our Q2 tightening, you can see that these are tighter than the whole economy targets, because historically the EU ETS has always been doing the heavy lifting. It's always perceived to be easier to decarbonize the power sector and heavy industry compared to a lot of the smaller bits. So here we're assuming a 90% reduction by 2050 in the ETS and a net zero line in the central just for the ETS. Now, if we look at the high, we've got a much more ambitious target that's closer to the proposed targets, and it would have to actually, in order to get to our net zero 2060 line in the whole economy, we'd actually have to see the EU ETS go net negative. So that means, firstly, a rule change would have to happen so that negative emission technologies could actually participate in the ETS, and secondly, they'd have to be used in such rigor that actually the ETS became a net negative sink. So that's a quick overview of how our targets have changed. And next, I want to just show you what the impact of that change has had. So here is again our central price track. This is our best view of how carbon prices will evolve, with our assumed target levels annotated here. But what we've done here is just to show in the shaded region what would happen if you were to flex that target by 3 percentage points plus or minus, and what would the impact be on price. And so to give you an idea of scale, this a 3 percentage point increase in the target, say in 2040, would result in a €10 increase in price. So really quite significant. And of course, if indeed the targets were much tighter than that, if they were 5% or even 10 percentage points, we could actually see a movement closer to €30 per tonne in 2040. So the key message here is that the ETS is extremely sensitive to the cap levels, and we're going to have to see how those evolve over time. So if we turn our attention to the other interacting policies that also shape the evolution of the carbon price, we can look at a number of these. So let's start with the German coal phase out. So the German government is in a bit of a predicament. It's committed to a coal phase out, but it's also conscious that once you phase out that coal, you also effectively have a surplus of allowances that come from that, and that will depress prices. Now, we've taken the assumption that the German government will cancel 50% of those allowances, and so that's our baseline here at a zero carbon price. That's our central baseline. But if the German government actually said, no, we're not actually going to cancel any allowances, then we could see a drop of, say, €2 a tonne, or conversely, if they were to cancel all the allowances, we could see an increase in €2 to €3 a tonne. So that's certainly one on watch. If we step forward to look at the impact of the carbon border adjustments, so this is one of the strands of the European Green Deal. The idea behind a carbon border adjustment is to protect European-based heavy industry, which otherwise would be exposed to imported high carbon products that aren't exposed to carbon prices. So imported steel from China or India that's not exposed to a carbon price. Now, by exposing those imports to the same carbon price that EU installations you actually level the playing field, and by doing so, you effectively help European industry, which would then see an increase in emissions. And if we just focus on the steel sector, we can expect a price increase of on the order of €2 per tonne if carbon border adjustments were applied to steel. And of course, if they were applied more broadly to cement or fertilizer or other carbon intensive goods, we could see a significant increase there as well. If we step on to Brexit, thanks to COVID-19, Brexit in the media has taken a bit of a back seat, but it's still rumbling on. And both the EU and the UK have outlined that they're happy with this approach, that the UK is going to come up with its own UK standalone ETS, and then in time that UK standalone ETS will link with the ETS. Now, it means those allowances will be fungible between the two schemes, and effectively it's not really any different from the current situation. But if the negotiations turn sour and no deal was really on the table, with no prospect of linking in the future, then we could actually see a price increase on the order of €3 a tonne. And that's because the UK is actually currently a net supplier of allowances. So if you excise that net supply, you actually make the market tighter, and that increases the price. In this scenario, we've also included the impact of GDP in a case of no deal Brexit. So that actually causes prices to be depressed in the back end here. But the primary focus should be on the near term in the 2020s. So it could be a significant move. And finally, if we turn our attention to technology costs, obviously AFRY puts a lot of emphasis on the technology cost evolution on the power side, but our carbon team also takes into account how industrial processes are also going to evolve. And here we're just looking at what would happen if we were to flex that industrial abatement curve by 10%, and you can see it could make it a couple of euros cheaper or more expensive, depending on which way we flex it. So again, a key thing to bear in mind how technology costs are going to evolve. So I'm just going to end with the final strand of the European Green Deal, and that is how other sectors might be incorporated under the EU ETS. So just to give an idea of scale, if we look at those sectors that are currently under the EU ETS, dominated by power and industry, and we look over the border here into things that aren't yet under the ETS, road transport has a huge carbon footprint, and shipping is also relatively large. The plan under the European Green Deal would be to try and bring these sectors inside the ETS, and from the chatter amongst industry experts, it seems like shipping has a fairly high chance of coming in, because it's seemed as quite easy to regulate sector. On the other hand, something like road transport, it's still, because it's exposed to other not carbon taxes, but other road taxes and so on, it might make it harder to actually integrate that into the ETS. But either way, how the impact on price as a result of this evolution will depend on exactly how the policy is implemented. So it will depend on the supply that's carved out in order to accommodate these new sectors. But we're actively looking into this space, and if you're interested, then please contact us for more information. So with that, I'll pass back to Bradley for some concluding remarks.
Thank you, Mostyn. So just to summarize some of the main themes from today, Mostyn's talked about net zero and decarbonisation targets. I think net zero 2050 is being considered, being driven forward by the Commission, but it will be very challenging to get there and achieve, given the hard to decarbonise sectors that remain past the current ETS. 2030 target of 50 to 55% is being discussed. Adoption of these targets and the level of decarbonisation ambition built into the ETS has a massive impact on the prices of the resulting market. Very sensitive to where those settle. COVID-19. A large part of the shock from COVID-19 has been absorbed by the MSR. The long-term GDP impact of COVID-19 is we're still to see what that will be, and it may have a significant impact on the market as well. Likewise, the MSR is an instrumental part of the market for at least the next decade, and changes there could have a big impact. Finally, there's a lot of overlapping policies which affect the carbon market up and down. Scope for expansion could be a big change to the ETS, while overlapping policies such as support for renewables has in the past can reduce the need for the ETS to be the driver of decarbonisation. So in the future, that might be government support for CCS or for hydrogen rollouts, which will have a direct economic overlap with the ETS, and typically, although not always, reduce the more policies you get of that nature, the more you reduce prices within the ETS. Stepping forward, we are active in working in this space. If you're interested, please do get in touch about anything we could potentially help you with. But at that point, I'll pass back to Matt Brown. Thank you all for attending, and I think we'll move on to questions soon.
Yeah, we got some questions, and also we'd like to. I'm gonna just so people stay for the questions. We're going to be asking a question of you, the audience. We're going to trial the poll ability of GoToWebinar. So please wait for that. Be just with the first question. So you can see also there are some more webinars coming up. We've got Mostyn's and Bradley's contact details, so please do get in touch. I was really struck by the importance of carbon prices in the formation. You know, how much of the electricity price now and in the future is going to be driven by carbon price. So it's a really vital part of the overall picture. If we go to the first question, Bradley, I think it was for you. What is the highest price of carbon that would be politically acceptable for consumer bills?
I think it's a very interesting question. This is one that we were asked ahead of or submitted ahead of the webinar. So as Matt said, we've prepared a poll to go with it. But I think it's clear that there's a clear acceptance that if prices get too high, there's likely to be some form of political response, but where that would come is very much not clear. I think people are going to be much more accepting of a carbon price of, let's say, €100 in 2050 than they would if it came along tomorrow. So we're thinking of asking all of you, if you have a view, let's step forward 10 years. In 2030, how high would the ETS price need to rise before you think there would be a policy intervention to limit that rise and reduce market prices? And we've given 5 ranges. If you can have a go at voting, we'll see what comes up. Okay, I think the voting's mostly stabilized. We'll try and get the answers shown to you, but the peak seems to be at around €100, which is fortunately or not, it's well above where we're projecting 2030 prices to be. Interesting question would be, how high would it have to rise in later years? So we get to that sort of level more around 2050 in our projections. But yeah, there's been substantial intervention in the carbon market in the past to counteract low prices, and prices being let's say below €10. I don't think we have any better insight than this of exactly when politicians would intervene, but it's clear that you get a lot of potential political feedback when prices go up that could drive a Commission response if they go too high. Okay, Matt, do you have further questions?
Yeah, sorry, I was just saying that that seemed to work quite well, and we only have one poll question this time around, but we'll make use of it more in our future webinars. I think now we've seen that it can work well. Next question: what is the probability that high abatement costs in other sectors will not lead to high carbon prices for the power sector?
I think within the ETS, the power sector is intrinsically linked to other sectors. So as long as power can provide abatement more cheaply than elsewhere, it will do so and it will set the price. But as you've seen on the trajectories, if Mostyn, you can flick to slide 10, for example, as the cap on allowances gets much tighter going forward, the power sector can't do it all. And once you're forcing in hard to decarbonize actions from sectors in industry and aviation, and if the ETS expands from elsewhere, then the price has to rise to pay for those. So the power sector very much once it's if it can't provide further decarbonisation cheaply, then other sectors will set the price that the power sector is exposed to. Okay, Matt.
How the EU Green Deal may affect non-EU countries. I think for the last question, how the EU Green Deal may affect non-EU countries. Who wants to take that one?
Yeah, I'll give that a stab. So I think the first thing to say is that the EU is one of the largest economies in the world, so it really does have some clout. If it's moving in the direction of net zero, then it is going to encourage the inclusion of more countries to adopt net zero targets, particularly if it relies on carbon border adjustments, because the beauty of a carbon border adjustment is that then there's a real impetus for the importing country to actually impose its own carbon regulations. And the holy grail is a global carbon price, and that carbon border adjustment mechanism could facilitate that transition.
Excellent, thank you. Well, I think we will call it there. I just want to say thank you everyone for joining the webinar. You can see next webinar is coal to biomass conversions, very important on a global context especially, and then renewable electricity in South Africa following that. I'd like to thank Mostyn and Bradley and Daniela for the material and the presentation today, and also to Bev and Johnny for helping put all this together. With that, let's close the webinar. Thank you very much, everyone.